As the global outlook continues to weigh on investors' minds, Geoffrey Yu, an FX strategist at UBS, joins me now to discuss current investor concerns, including the Chinese slowdown, volatility in the FX market and the effect of central bank stimulus. Geoffrey, thank you very much for speaking to me. Now, first of all, the Reserve Bank of Australia surprised many investors this week by cutting interest rates by 25 basis points to 3.25%. Now, that triggered a major sell-off in the Aussie dollar versus the US dollar. Was this an insurance move by the RBA?
Actually, I think it was only surprise in the sense that they didn't do 50, and quite a few of our clients were expecting such a step. Yes, it is an insurance move that they are worried about in terms of trade deterioration and maybe some sluggishness in employment creation. But if you just assess the scene in G10 currencies out there, the Aussie still looks a better bet than most. Of course, you'll have to look at the growth outlook for China up ahead and wider demand for commodity block currencies and commodities in general. But in the current environment, we'd be cautious in pricing in something aggressive for the Aussie. The market is actually pricing in close to 100 basis points in cuts at this stage. So another 25, which is what we expect in November, shouldn't do too much damage. And on the contrary, if they do signal that rates will base around 3%, and maybe Aussie can rally around these levels. So right now we're quite neutral on the currency. Don't like it higher too much, but wouldn't say that the RBA is being aggressive in any way whatsoever.
Well, what about China? Denting sentiment today was fresh evidence about the extent of the Chinese economic slowdown. As we know, they're approaching an important leadership transition soon. Markets are still hoping for a stimulus boost from China. Do you think they're still assessing the pros and cons of aggressive fiscal and monetary policy?
I don't think they're assessing the pros and cons because they're more cons than pros. That's well known. It's a well-trodden path right now. China's looking for structural reform. Aggressive fiscal and monetary policy are only cyclical elements right now. They really want to look beyond that. They don't want to generate growth for the sake of generating growth. They want to make sure growth is sustainable in the longer run. So I wouldn't count on any favours from the Chinese in the immediate future.
On the subject of central bank easing, the policy easing path seems to be the preferred method of choice at the moment. Who's next, do you think? And also, how optimistic are you about the impact of central bank stimulus?
In terms of who's next, probably the BOE is going to add the QE, and we need the ECB to start its OMC program. And as I mentioned earlier, RBA is going to cut rates as well, so they're adding stimulus as well. In terms of the impact of central bank stimulus, quite agnostic on this, to be honest. We won't know it's over until it's over. The recent QE plan announced by the US, the focus on mortgages and ultimately putting more money in the pockets of American homeowners, it is an interesting step. So by changing tactics somewhat, maybe they're looking for greater efficacy. But it's reasonable to say that we may be nearing the end of conventional QE experiments. If these things don't work, there may be a convergence towards something like an FLS scheme in the UK. So would that be expanded across the board, for example, where central bank balance sheets will expand, but they'll try to bypass the transmission via the banking system and try to get the money multiplier in the broader economy up and running. But that's probably some discussion for next year.
Focusing on Spain, speculation continues as to when they will ask for some kind of rescue. Obviously, Spain needs to stay in the investors' good books, but do you think investors are losing patience in this waiting game?
No, I think investors are confused more than anything, because if we do get quote-unquote good domestic announcements from Spain, such as some stronger fiscal plans, that actually could be designed to buy them more time, and they'll probably delay any request for aid. Whereas if we get nasty news for Spain, either on the banking side or such as the joint statement by the German, Finnish and Dutch finance ministers recently, which pushes up Spanish yields, if that nudges them closer to asking for aid, that is, even though it's bad for markets, it's actually a good step. So probably a wait-and-see attitude right now. People are waiting for event risk to clear, but if we get to November and there's still no request for aid, then it could be a different ballgame and it will be negative.
A trading range for the euro-dollar then for the time being, but what are we looking at here?
I think we're going to stick towards the 125 to 130 range over the course of the next 3 months or so, because even if we do get a short squeeze, let's say in the euro, if Spain requests aid, the next phase is going to be the OMC activation, balance sheet expansion, and that's not conducive to euro strength.
We're getting closer to the release of that Troika report assessing the sustainability of Greece's debt in the longer term. How concerned are you about Greece right now?
I'm concerned insofar as the unknown unknowns which could bring to markets, and the impact of the May elections initially, which were dismissed outright, and now people are not going to make the same mistake. So if, let's say, anything with the Troika report and the Troika's own tactics and negotiations do result in instability on the political front in Greece, then that could be a negative event. But I'm sure that the European IMF will have learned from mistakes of the past as well and try to avoid that.
Do you think risky assets will be able to sustain their impressive rally from Q3 as we move into the end of the year? Or do you see a pickup in market volatility further into autumn, given the important events taking place over the next couple of months?
I would favour the latter, so a pickup in market volatility should happen. It will be driven by the Eurozone and maybe some minor concerns over the US fiscal cliff heading towards year end, although we don't see that as a major issue. It is being talked about a lot, but it won't be the key driver of volatility, and we will see some greater ranges in the major currencies up ahead, but we would not be surprised if such moves happen much later than expected.
Geoffrey Yu there from UBS, thank you very much for your comments. Now make sure you stay tuned to DukascopyTV for the rest of the day for more exclusive interviews, as well as a fresh edition of the Press Review and Targets in Focus. For the moment though, goodbye.